Mari, who will be speaking to you. We've got our interim CFO, Moses Muthui, who again will be speaking to you this morning. But I'd also like to introduce some of the members of our country management committee who are joining us today. Let me start with David Hardisty, David is managing principal in charge of our retail and business banking. To his right, Mr. James again, managing principal in charge of corporate and investment banking. To Agin's right is Ruth Maora. Ruth is our interim chief operations officer. To Ruth's right is Christine Mwai, Madam Christine Mwai. Christine Mwai is our country credit director. And then we've got Mombi Kahindo. Mombi Kahindo is our people and culture director. And then behind there we've got Shera Waithaka, who is our chief risk officer. Then back to that table we've got Caroline Kendi, who is a chief marketing officer. I hope I haven't left anybody. If I have left your name, please pardon me. All right, I think we have a quick program. As I said, we will have presentations from our chairman first. Our chairman will then be followed by a CEO, will then be followed by a CFO. Please note down your questions. We'll have a Q&A session at the end of the presentations. We'll allow the members of the media to go first and quickly follow through with the analysts that are joining us in the room. We are joined, this program is being broadcast on our social media platforms. And so a very warm welcome to all of you out there, our different customers and stakeholders who are following this. You're welcome. Please leave us with your comments and questions, and we'll try as much as we can to attend to those. I think without any further ado, I'll invite the chairman of the board, Mr. Charles Moshene, to come and he make his opening remarks. Thank you.
Thank you, Charles. And a very good morning to each and every one of you, ladies and gentlemen. Thanks very much for coming here to be with us this morning. We very much appreciate the interest that you've shown in the performance of this business and sparing the time to be with us. And we trust that the next hour or so will be informative and productive. I'm going to be brief, and we'll touch on three broad themes and topics. I'll say a little bit about the CEO leadership that the business is going through currently. I have no new news, but just to reiterate where we are for your information. I will then talk about the environment in which we carried out business in 2022 and some of the key outcomes of that exercise. And I will then close off with a reflection on the strategy horizons that we've had so far and the next horizon. So starting off with the CEO transition, you all know that Jeremy Awori announced to us, actually, he came to us and he told us that he intended to pursue his career outside Absa. That was in September. And we agreed on a date, an end date for him of the 31st of October. We then initiated a process to start a search for a CEO, and we appointed Yusuf Omari to be the interim CEO and MD until the next MD is identified and onboarded. And then after that, we went through a search, a very rigorous and competitive search, which yielded one candidate, and we made an announcement at the end of last month that we had identified Abdi Mohammed as the MD designate, and he would be appointed to take office once the regulatory approvals have been completed, and all the other matters are all in hand. As you would know from his profile, he's currently the CEO of Absa in Tanzania, and he's also doubling up as the interim managing principal for the retail and business banking business across the continent, with the exception of South Africa. So there has got to be a smooth transition in all those positions. Once everything is in a row, we will make an announcement as to what the effective date of his appointment will be. So that's the news I have for you on that. It's really not new news, but it's just an update. So moving then quickly as to why we're here, which is the financial and other performance of the business. Let me start off with the operating environment that we found ourselves in 2022. I think it's fair to say that 2022 was a much better, we had a much better environment than the preceding year. But that does not mean that it was not without its challenges. We had a number of headwinds as an economy to deal with. And as you know, the fortunes of financial institutions follow those of their customers. So anything affecting our customers would have some knock-on impacts on us, whether it's good or bad. So in terms of the headwinds that we encountered, I think the biggest impact are the economic consequences of the ongoing war involving Ukraine and Russia. And particularly since it affects so much of some critical components of the food elements that we buy, and in particular wheat and vegetable oil, with the knock-on impacts and supply impacts and impacts on the availability of funds for customers to use on many of the goods that our customers deal with and services as well. We also saw a tightening of the global monetary policy. All the central banks around the world trying to manage inflation by increasing interest rates and so on. And that has had an impact. And we've also seen, starting 2022, and this continues even today, a flight of capital to what it sees as safe havens, and therefore that's impacting on our economy. We've seen bodies like IMF talking about economic growth. They are scaling down the anticipated economic growth in a number of countries around the world, which is also going to have an impact on us and has had an impact in 2022. There has also been a drought in parts of the Horn of Africa, impacting on many people, and some of the resources have been taken there to provide some form of safety net in there. So it has affected economic performance. And then we saw some muted foreign direct investments in this marketplace because of some of the impacts, the leftover impacts of the COVID restrictions and so on, as well as the monetary policies that I referred to earlier on. But having said that, I think Africa is looking up. We have lots of opportunities to reverse that. So with the Africa Economic Unit coming into play, and with Africa being seen as the next growth horizon, with our young population, well-educated young people, we stand a good chance, and it's anticipated that we will see a reversal of that. As for the other headwinds, I expect that those will continue to be felt into 2023, and when we stand here next year, we'll probably still be referring to them. But that does not mean that it was all doom and gloom. We had some tailwinds which presented us with opportunities. The COVID restrictions receded, and so there was a lot more economic activity across the world, with the exception maybe China, but even with China towards the end of the year, we saw them lifting some of those restrictions, supply chains opening up, business picking up, and the economy looking up. We also had a smooth transition in government, and so that gave renewed confidence in this economy, and the economic activities picked up fairly well. We saw a growth in private sector credit, and there's consumer confidence. There's a lot of activity in the SME sector. And that's a really critical sector, as you know, which accounts for about 40% of our GDP and provides up to 80% of the employment opportunities in this marketplace. And when there's growth in that segment, then the economy looks up and there's growth and opportunity for everyone. And within the bank itself, we saw lots of significant growth momentum. So given that environment, what did that mean for the business? Well, if you think about the financial performance and you've seen the results, we have a really good and strong financial performance, which is in the numbers that Yusuf and Moses will be taking you through later on. We have a very strong balance sheet, and we saw significant growth in the balance sheet this year, which puts us in a strong position. We've got strong capital base and strong liquidity, which puts the business in a really good place for the future. And given the performance that we had last year, it's only right that the shareholders participate in that growth. And so the board decided to recommend a higher level of dividend than we have seen in the previous year. And also we have seen our business participate very effectively in the growth to the private sector credit, and also growing, basically lending in all sectors. So that's a really good thing. So in a nutshell, that's the performance that we saw in 2022 and the environment that we were in. So if I could just briefly talk about really very adversely affected by the crisis, and Barclays was no exception. So the business was in decline. And that's when we had the growth, transformation, and returns agenda. And you'd have seen from the performance over those 5 years that the growth of the business continued to accelerate, and we saw revenue up from 30 billion to 46 billion during that year. In the area of transformation, if you look at the cost-to-income ratio, we started off with 55%. Today, it's one of the best recognized brand in this marketplace. And it's not just recognition, it's appreciation of what is about the next horizon. We're in a really good place. We've got a strong balance sheet. We've got a strong brand. We've got all that, and grow the business to scale. We want to deepen the business, particularly when it comes to the retail space. And to do that, we've got to reach out to the population bulge, and this is the youth. We've got to have offerings that appeal to them, and the channels. So the youth agenda and the digital agenda are key to our strategy for the next horizon. And business banking expand space. We are also looking to leveraging on ecosystems, particularly when it comes to the corporate and investment banking customers, who are primarily the large businesses in this marketplace. They've got ecosystems of distributors and wholesalers and so on, and leveraging on that so that we bank the entire ecosystem is part of our strategy. And we shall continue with the digital transfer. This is paying fruits these days, going through the digital channels as opposed to walking into brick and mortar outlets. And we've got this brand which is taking traction. It's coming across as a force for good, and we shall continue building on that and continue building on the talent that we've got to enable us to respond to the challenges that we shall face in this in the new environment, while at the same time being inclusive in all dimensions of the word. I know I could go on, but that's really not why here. My objective was just to give you a flavor of where we are coming from, how we did last year and where we are headed. Management will be coming shortly to unpack everything for you. But my message to you is that as a board, we are really happy and pleased and really proud of the team that we've got running this business. Management, as well as everybody in the business, including those ones at the counters and the call centers attending to staff. They've got the right attitude, they are engaged, they are excited about the prospects, they value customers, and they have delivered, because of that, an incredible performance, and we applaud them. And with that, let me hand you to Yusuf to take you through the rest of the presentation. Yusuf. Okay.
Thank you so much, Chairman. Ladies and gentlemen, good morning. You know, we released our results yesterday after the market closed. And then when I went to bed, I woke up at night. It rained heavily. I don't know if you guys felt it. And so I said, this is just coinciding with these lovely results that we'll be sharing with you. So, and we are praying, and let's continue to pray for rain. As the chairman has said, one of the headwinds is actually drought in the country. And if you look at the macros, all the challenges that we faced, a big chunk of that is actually on the drought situation. And when you look at it going forward, again, that also is a very big area. We've started seeing the price of oil coming down, but then the price of food is still a challenge, and we're importing quite a lot of that as well. So as Chairman has said, I will just unpack more on what we've been able to cover from a strategic point of view. And if we look at the conclusion of what we call the second horizon, which is a period 2018 to 2022, you'll be able to see that we've managed to do a we've been able to make significant strides on all the three key pillars. So the first one is in terms of growth from a revenue perspective. Later on, Moses will be able to share with you the details on the financials, but being able to do revenue growth of 25%, that is quite impressive. And that is really, when you dive into the details on the numbers later on, you'll be able to see, it's really well diversified. You'll be able to see a split between our retail business and what we look at wholesale on the other side, like a 50-50% split on the revenue. It from a perspective of net interest revenue and non-interest revenue, you'll also be able to see good trajectory picking up on that as well. This is informed because of the diversification that we've been able to introduce during this horizon. You'll be able to see later on 16 new revenue streams that we were not participating, or even if participating in a smaller scale. And over this period, then you'll be able to see that picking up so well. On the side of transformation, really moving from a period where our cost-to-income ratio was in the high 50s to a time now when you look at our cost-to-income ratio, it's come down to actually the low 40s. And now it gives us a very good springboard to be able to now do significant investments, especially on the side of automation, digital channel, and giving our clients options, different channels for them to be able to do business with ourselves. And then lastly, really there is, when you look at the returns coming to our shareholders with the promise that you'll be able to get both capital appreciation on the stock and also, more important, which later on today we'll dive into that as well, is by looking at the dividend yield, the dividend that we are declaring relative to the cost, the investments that our clients, or rather our shareholders, have been able to do. Period 2008 and 2013, a growth of only 4 billion during the entire of that period. 17, another growth of only 2 billion during that period. And then now you see the scale, the jump between that period and the reporting period that we are having, which is 2022, a 7x jump in our revenue over that period, which is really tied to the strategy, the GTR strategy that I've mentioned, and the fact that we were able to introduce different revenue streams. We were able to do the separation, back in 2020. We were able to do the investments that were required, and our focus right now has always been to outperform the market and to be able to make sure that as a minimum, our market share is picking up. If we look at just the split of the new revenue streams that we've been able to introduce over the period. Back in 2017, holistically, you talk of like 4 businesses during that time. And today we are saying the Absa of 2023, with 16 new different propositions that have been introduced. We were not big in SME. We were not big in business banking. All of that we've been able to reintroduce into our array of products. And I must tell you, business banking is one business that has done so well consistently over this period, all the way from 2018 to 2022. If you look at the financials and we split that and ring-fence the business banking element, which is where we house our SME product, you'll be able to see double-digit growth rate. And to be honest, later on, when we look at the strategy, and I know the chairman has already hinted to that, that becomes a focus to us, especially considering the relevance of this business in this market. We've been able to introduce wealth management. We've been able to introduce, our business in securities. And the new kid in the block is the custody business. You recall a few years ago, we used to do custody business. We exited that business. But now we are seeing opportunities for us to be able to get back into that business. And the reason really here is to be able to have a one-stop shop for our customers where all the array of services are available to them. Then that then drives to the issues of customer primacy, where they're able to get all the services that they require within Absa. If we look at the story of the cost-to-income ratio, as mentioned, moving from 55% coming down to now 41%, a lot of investments have been done for us to be able to get this kind of efficiency ratios. We've done automation, both on the side of back office and then also automation when we look at front office. How are we dealing with our customers? Today, over 92% of our transactions with our customers are basically going through alternate channels rather than the traditional brick and mortar, the branches that we were having. And with that, it gives us a breadth for us to be able to invest to areas where the customers get the greatest value. So we are driving efficiency on the back office. We are creating alternate channels for our customers on the front side, and that just gives them, the conveniency for them to be able to do their business. The slide that breaks this down is what is in front of you on the screen. You see the investments on the corporate level. Of course, what the chairman mentioned on the rebranding. Absa brand right now is ingrained in this economy. Everyone speaks to, knowing from an awareness perspective of the new brand. We've gone to our back office. We've managed to automate 52% of all our back office processes. we are still continuing to do these investments. And just to give you an idea, last year alone, the financials that you're looking at in 2022, about 2 billion shillings has been spent on about 75 projects just to make sure that this automation agenda is really core to us. On the front office, over and above giving alternate channels to our customers, we're now moving a notch higher, where we're saying, can we partner with the fintechs in this country and even beyond for them to be able to give us services that speak to our customers? Ageza is just one of the fintechs that we've been able to partner, which emphasizes the importance of the ecosystem, especially when we're looking at our distributors who are tied to our clients. I mentioned a bit on back office, the automation. We've been able to do that, being among the first banks in the country to use robotics to be able to create a seamless walkthrough on all the back office processes that we are doing. I mentioned the brand awareness score, quite interesting. When you look at back in 2019, and you go to the street and you ask, randomly, any client, do you know Absa? This is exactly the kind of feedback we got at that time. We had 28% of the customers having the awareness of the brand. If you look at this score right now in 2022, we are talking of 92%. More than even the previous brand that we had at that point in time. And then when you just go, in terms of just getting feedback through research, in 2022, we were ranked as the most reputable bank in Kenya. All this is just underpinned through that GTR strategy that we've spoken to. And we are bringing this not just from a customer perspective, but then also looking at what our own colleagues are telling us. And if you look at the bottom there, the colleague brand love score at 73%, among the highest in the industry. We've tied this by just not looking at our customers, our colleagues, but then also going to the society. Last week, we concluded the Magical Kenya presented by Absa golf event. We were able to interact with quite a number of our customers, and all of this is just to drive the element of the brand awareness. We spent about 70 million shillings just in terms of that sponsorship. I know golf has been, misconstrued to be an elitist sport, but then right now we are pushing that. We're extending that scale to make sure that it can be available together with the government all the way to the schools, for the youth to be able to participate in the sport. And the feedback we received just from this, investment, the brand awareness, you're seeing there over 5 million people reached through media. 5,000 people engaged during that 4-day event. And then linking that with sustainability, where we said we'll plant for everybody, you get to plant 100 trees, targeting about 200,000 trees, which we know is part of the government agenda, just in terms of returning our forest cover. We've looked at this. I mentioned earlier on, we've looked at the side of SME. We've dived into understanding what our SME customers require. They contribute over 50% of the GDP in this country. The SMEs create 80% of employment in this country. So it's not a sector you can afford to ignore. And I must say, last year, towards the end of last year, we went to 10 counties, visited 10,000 SMEs, increased capacity, opened to them areas of marketing their products, create capacity in terms of just coaching them, financial skills, and the feedback, to be honest, has been quite tremendous. As mentioned, this is the area where we are seeing that leap and jump in terms of the business picking up, which is reflective on the financials that Moses will be sharing shortly. On supporting customers and being a force for good in this economy. When COVID happened, a third of our book was affected. 59 billion at that point in time. And we were able to give repayment holidays for all these customers. I must say at this point in time, over 90% of these have actually come to fruition and the loans are actually performing. In supporting the government agenda, you recall the president, launching the Hustler Fund, the fact that we had quite a number of customers who had borrowed small amounts to the tune of even 1,000 shillings, but they were listed. We played our part. We delisted about 396,000 customers who we had given facilities. They were listed, and through the initiative, we were able to support them. And not just from a perspective of delisting them from the reference bureaus, but also giving them a 50% waiver. I must tell you, we had written off all of these loans, and anything that is coming through that is just flowing through through our P&L. I must comment from the president initiative. This was quite powerful, and today you know how the Hustler Fund is performing, and the fact that it's actually giving the youth an opportunity for them to be able to do their businesses. And then lastly, just looking at these financials, we've grown our loans last year from a gross perspective, year on year by about 148 billion shillings. And in here you have SME, business banking, retail customers, and of course on the side of corporate. Bringing it back to our colleagues, they're the ones who are driving. They're the driving engine when it comes to running with our strategy. We've been able to revamp our employee value proposition, looking at areas of care, culture, contribution, and their career growth. What you're able to read here are the sentiments that are coming from our colleagues. When you see that 73% score that I mentioned earlier on, it's because of the brand love. What is the bank is able to connect with the colleagues, not just in terms of empowering the colleagues, but also looking at their career. Today, we are among the few institutions that is still doing hybrid working conditions. Today, I'm sure there's someone who is seated in his home, equipped with all the necessary tools, and they're working. And they've been doing this since the time we started COVID. We did not stop it. And even today, we still have a very big workforce that is still working from home. On the side of sustainability, we focus on 4 key areas. You see the first one there is on the side of environment. You're seeing the agenda in terms of supporting the government initiative on trees, targeting to plant 10 million trees as a bank in the next 10 years. The bit on education and skills, training 250,000 customers on youth in terms of ready-to-work initiatives and extending that also to our customers. The third one in terms of promoting a just society. We've been able to establish computer labs in schools, and we've also been able to target our customers in terms of giving them opportunities to do business with ourselves. Today, about 10% of the suppliers in the bank are women-led businesses. We have a target in 2025 to push that to 30%. And that just creates the diversity that is fundamental when we are looking at the core pillars on sustainability. And then lastly, there is inclusive financing, where we've picked quite a number of areas just to be able to support, from a society perspective. Lastly, on the returns, you see over the period back in 2017, a return on equity of about 16%. We had a dip back in 2020. You know that is because of COVID. And now you look at where we are, a return of 23%. That's what we are communicating to our shareholders. And it must, if you're a shareholder, I'm sure you must be impressed with the kind of returns that you're getting from your stock. And then on the bit of what we've seen in the market, just in terms of trading, you see Absa at the top. And this one we have a base of 1st of January 2018 when we started the GTR, the Growth, Transformation and Returns Strategy. You see a return of 28%, and we've been able to track some of the top banks and see how they are performing over the period. And clearly you can be able to see a massive differentiator in terms of what we are taking back to, to our shareholders. Our dividend yield among the top in this industry. And today as well, you saw the financials yesterday. We declared a final dividend of 1.15 shilling per share, which brings a total dividend for last year to 1.35, which is about 23% increase on our dividend yield, on our dividend declaration when you compare it from year-on-year perspective. And then just to conclude on this one before I invite Moses here to dive into the numbers, all of this are the recognitions that we've been getting as a result of concluding on that strategy. I think top employer, which speaks to our colleagues, getting this this award in 2 subsequent years, 2022, 2023, quite a strong sentiment in terms of the connection that we are putting together with our colleagues. Ranked most reputable bank by GlobeScan, and I can go on and on. I think this is really just for your information. So ladies and gentlemen, I think a good strategic period. We started, just as Chairman mentioned, curbing the drop in our market share back in 2008 all the way to 2013, coming in and doing the necessary investment now to take us to the next scale, and then now coming with a new strategy, the GTR strategy, which was focused on growth, transformation, and returns, and clearly seeing what is quite impressive. So let me request Moses to come and dive through the financials, and then I'll just come back and recap, and then open it up to Q&A. Thank you.
Yusuf, thank you. Good morning, everyone. I did not hear the rain. I think I need to move to Yusuf's neighborhood. And maybe it's because for the first time for full year results, we had published our results yesterday after the market closed, and there was very little to hide. Numbers are already out, and hopefully they're more good news than the other news. So I had a very good night's sleep. Thank you, Yusuf. I'll spend some time talking about the financials. And because the numbers are already out, I'll make highlights on financial performance. And I'll try to give a little bit more about the sentiment, just the drivers of the performance, the key messages as we see them as a management team, and where we think we're headed in terms of our financial outlook. I'll cover a little bit about the forward guidance, and then I'll invite Yusuf back to cover the next strategy horizon, which is the strategic priorities for the coming years. So if I look at the overall P&L, and I start with income growth, we've really seen a standout growth in revenue. Revenue last year grew by 25%. 25% is 9 billion shillings. 9 billion came last year. And what's good about this is every quarter through last year, the growth rate accelerated. Quarter 1, growth was 12% year on year, quarter 2, 17, quarter 3, 22, quarter 4, 25. So the momentum is really good. And that build up across the year, which gives you a sense of where Q1 this year might look like. If I look at costs, our costs went up 12%, but we have a one-off in that number. And by the way, with revenue going up 25% and costs only going up 12%, what we call cost-income jaws, how much are you generating for what you're spending, is 13%, double-digit jaws. But even that 12% cost growth as a one-off number, and I'll unpack that later, So the underlying business cost growth is actually 5.9%, is 6%. So we have underlying cost growth that is supporting revenue growth of 6% and revenue 25%. Yusuf talked about our efficiency ratio, which has come down now to 41%. Our target has been 45%. If you work the numbers, we could have spent an additional 2 billion shillings of cost last year without touching 45% target. So this just shows you the importance of having a business that is really efficient and that has the capacity to invest in itself. We don't think we are comfortable at 41. We think that number should go up so that we can invest in the business. But there's so much pressure on revenue that number is actually coming down in terms of the cost-to-income ratio. So it's up to us as a management team on how we reinvest first into the business. If I look at profitability, profit after tax and profit before tax up 34%. Return on equity 23% from about 19% the year before. So not only have we grown our top line and our numerator of our returns, but we've managed our capital very well to ensure the return on equity is also improved. When you look at the market, we are seeing results of return on equities of mid-teens to high teens. So we think we are beating the market on this one. Same on revenue, same on efficiency. So look at the entire P&L. We are quite pleased with the outcomes. If we look at balance sheet origination, our assets, customer assets, went up 21% last year. And that 21%, again, momentum built up across the year. So quarter one, assets growth 11%, quarter two 19, quarter three 26, and 21 to the end of the year. Portfolio quality, non-performing loans. Our non-performing loans ratio, our NPL ratio, came down to 7.3%. And I'll go to the details around this. With the industry at 13.3 or around 14, we are running way low in terms of portfolio NPL ratio, and our portfolio is quite good, of good quality compared to the industry, and we are pleased about that. And then lastly, on this table, when I look at valuations, because at the end of the day, we have to demonstrate we are creating value, and that is demonstrated through our book value. Our book value has increased. Our stock price has gone up slightly, our book value has increased, and we are still at a premium valuation. We are trading at a premium valuation above our book value. And finally, Yusuf talked about this, dividends have gone up to 23%. So we're going to pay 7.3 billion shillings to our shareholders, which is 23% increase from 2021. So these are really the P&L numbers and how they look. But let me share the story behind the numbers and the sentiment behind the numbers. The first one is our growth is broad-based. If you think about our car analogy, all the cylinders are firing. If you look at that 25% growth, our slowest growing business grew 19%. So retail grew 19%, business bank grew 26%, financial markets business grew 29%, our corporate and investment bank grew 39%. So growth is broad-based. No one is being left behind in this growth that we saw last year of 25%. Out of that 9 billion revenue growth from 36 to 45.9, 4.5 billion of it came from volume. Half of it is the balance sheet growth. 3 billion came from yields. Interest rates were going up. We repriced our loans. So 3 billion came from the fact that the yields environment. So it's not so much that we waited for the price environment to allow us to price for loans so we could make income. There was actually productivity. 4.5 billion of the 9 billion was business productivity in terms of volumes. And then the 1.5 to make the 9 billion is from fees and commissions and our FX business. So again, when you look at it that way, growth is both supported by market environment as well as internal productivity, which we are proud about. When you look at net interest income and non-funded income, net interest income went up 28%. And this is really from the core of banking. You know, as a bank, we manage risk. We price for that risk. We earn interest income from pricing for that risk. Then we transform deposits to lend, and then we pay interest for those deposits as we do that transformation. The net of that has resulted to 28% increase. So for the core of what we do as a financial institution, our core business model has delivered that 28% growth. Non-funded income up 17%. In an environment where we saw, and here I begin to share some of the areas of our P&L where we think there's room for improvement, where we saw fees and commissions reducing 20% because of lending activity and whatnot, and accounting treatment. The overall non-funded income is up 17, supported by FX growth and FX income growth. So even though fees and commissions came down, overall NFI, non-funded income is up 17. Then finally, just to conclude on how broad-based our growth has been, when you look at retail wholesale, the split of our revenue is 51-49%. So we have a fairly diversified revenue business, which helps you hedge for economic cycles. You know, retail banks do well when the economy is doing well. Corporate banks do well, bizarrely, when the economy is struggling, and financial markets business. So whichever the cycle we are in, we think that 50-50 is really going to help us to create a hedge as we look forward. The second story behind the numbers is operating leverage, or simply put, what are we doing with our cost base, and what is our cost base giving us? So our cost base went up 12% to 18.7 billion. When you remove one-off, which is related to a non-recurring expense based on some litigation matters that we are providing for, your underlying cost growth is 5.9%, below inflation. So we've created a 25% revenue growth with a below inflation cost base increase. When you look at, Yusuf talked about the journey we've traveled to bring us to 41% cost to income ratio. But when you look at the jaws, how fast cost is growing relative to how fast revenue is growing, the jaws are expanding. It tells us two things, that expanding is good, but it's good enough if you are investing for that lower line of cost growth to go up. And as you do that, push the top line to also go up. So the jaws conversation as a management team is, how do we keep them expanding, but expanding, I don't want to say diagonally, but upwards. So both lines are going up. Yeah, so revenue is going up and cost is going up. We'll be fine so long as jaws are positive. We have no challenges increasing the cost. So how do we do that? How do we continue that? As opposed to the jaws shrinking. When they begin to shrink, we either cut costs, which then damages your revenue growth. So the story behind our operating leverage and efficiency is exactly that. Managing on a ratio basis to invest in the business as we drive revenue growth. The third story is profitability. In many years ago, and Chairman talked about this, and Yusuf, we used to make profits by saving costs and impairment. Our profit growth, 3.7 billion, 9 billion came from revenue. And then that was watered down by the reds, which is, of course, cost have got to go up, impairment has gone up, tax. We have to pay our taxes as revenue increases and profitability increases. So we have the quality of our earnings come through when you look at the driver of our earnings, which is mainly revenue growth, which begins then to make it more sustainable. Because when you start to drive profit growth with cost cuts, there's a natural ceiling. You can't cut too deep. And this is good. And then on the numerator side, with this profitability is how we managed our capital. And when you look at on the chart, on our return on equity, with our cost of equity staying at 14.5, our return on equity, you see the green mark, return on equity is creating a good accretion. You know, the return above the cost of equity is really looking good. Again, it's like the Jaws conversation on cost and income. Is how do we keep that expanding diagonally? So if our cost of capital goes up, our returns must also go up. So that difference, the upside or the accretion, is also positive over time. The fourth story is balance sheet origination. Last year, we grew our loans and advances by 50 billion, from 234 billion to 283 billion. Only 16 billion of that came from unsecured lending, 30%. 70% came from either short-term loans, trade loans, secured lending, or segments that we find safe in terms of credit risk. So our growth has not come at the expense, our revenue growth has not come at the expense of putting risk in the system. You're actually seeing only 30% or 16 billion or 50 billion coming from unsecured lending. And it doesn't mean unsecured lending puts risk in the system, because we also price for that risk. So his net tells you that we are probably thinking about our balance sheet growth cautiously in a smart way, but growth anyway, as opposed to pulling back growth, given tough macroeconomic environment. And I think this is what's going to differentiate different players in the industry, because the economy will get tougher. Then we have to think about how do we smartly grow the balance sheet, because we have shareholder obligations to make a return. Yields went up 9.7 to 11, that's about 1.4%. That gave us the 3 billion shillings of revenue out of the 9 billion growth, with the volume, 50 billion, giving us 4.5 billion, 50% of revenue growth. So productivity of our balance sheet and what our colleagues have been able to do with our clients and our customers has driven revenue growth. And the yields have contributed. If yields plateau, you want to put yourself in a position where that plateau finds you with a bigger balance sheet, that you've already started accruing revenue. And so I think we are well positioned there. When you look at portfolio split in terms of loans and advances between foreign currency and local currency, given the currency depreciation that we are all experiencing, we've kept it fairly similar, with foreign currency assets only increasing from 31% to overall assets to 34%. Yet we saw in September a significant growth in trade loans to support oil importers, which are mostly foreign currency loans and trade loans. So the split has stayed fairly the same. And because we injected capital last year towards the end of the year of $50 million, which came to us in foreign currency, when you look at net impact to our earnings, we're in a better space than we were at the point where foreign currency assets were 31%, because we've hedged a bit of how we fund those foreign currency assets. And this tells us we have opportunity to do more foreign currency lending if the market opportunity is there, given we've just injected $50 million of capital. So smart balance sheet origination with its own challenges, but we are very much aware about where this is headed. The next one is portfolio quality. These days, bank CEOs and CFOs have to carry chief risk officers to investor briefings, so we have share over there. So let me translate, and then we'll deal with this later. So our loan loss ratio ended up at 2.3%. When you look at pre-COVID, before COVID, it was 2.2, right? So it's largely gone back to where we were in pre-COVID. So it's not unusual. It's not out of this world that it's 2.3. But here's the difference. Between 2019 and 2022, our loans and advances are up 90 billion. So we've increased our assets by 90 billion and kept loan loss ratio the same at 2.2. So even though the industry is running at 1.8, 1.9, what is the cost of carrying another 30 basis points to make sure you're growing 90 billion of assets? Last year, only assets went up by 50 billion. And then the other 40 billion was between 2019 and 2021. So we're not very much worried about this increase in loan loss ratios, because the balance sheet has also significantly expanded. That's on, and then there are obviously reasons for that growth, right? One is we've increased forward-looking provisions as opposed to releasing forward-looking provisions. So remember with COVID, and of course with IFRS 9, which came in 2019, and the concept of expected losses, you had to start taking losses immediately you book loans because of IFRS 9. Then COVID came, the portfolios were challenged, and we began to take more forward-looking provisions to help us as we recovered through COVID. There was a choice, because provisioning is management judgment. We had a choice to release those provisions or to actually say, what about Russia and Ukraine? What about coming through the election period? What about the economy in 2023? So even though these forward-looking provisions were tied to COVID, we've kept them and actually increased them because we think the economy generally is going to be in a relatively weaker position than pre-COVID levels. And so we had to take that management to increase those provisions. And of course, there's portfolio related. 50 billion of assets contributes to some of the the loan loss ratios. On the right-hand side, and this is where it may begin to sound conflicting. Impairments are going up, NPL ratio is coming down, and our coverage is going up. So it may begin to be like, so if you're already providing more for expected losses, why are you increasing your coverage? Why are you assuming you're not able to collect and yet you've provided? Right? So again, this was another debate and discussion as a management team. And perhaps the analogy to use is to say, look, we know we're going through a slippery road. And so as drivers, do we drive without brakes, without checking if they actually work? Do we drive fully on brakes? Or do we drive and keep making sure the brakes works as we go? And this, we've chosen the middle road to say, we think we are provided, and we think our NPL ratio is coming down, and even though we have securities on loans, let's take a judgment. We may not realize those securities fully. So customers may not, or market conditions may not allow liquidations to the unfortunate event to happen as quicker. So let's increase our coverage. So one can say, are we being overly cautious? But I think we're being reasonably cautious because we think the roads are slippery. So the numbers, when you add them all together, prepared for macro headwinds that are coming our way, well provided, backward looking, well provided, forward looking, and portfolio quality improving, even though industry is at 13%, improving to 7.3. So hopefully that gives you, because this conversation is also about judgment. What does the management think? There's the accounting principles, but what do we actually think? And we've erred on the side of caution and prudence as we thought about our judgment on this. Then finally, before I summarize, is valuations. The stock market will do what the stock market will do because of many factors. What we feel we're in control of as a management team is franchise value. It's actually the book value of the company. And when you look at the book value of the company, 44 billion 2018, 63.6 billion today. Last year, 13% increase. So the value of our company, the intrinsic value of our company, has significantly gone up. But good news is our earnings per share have also gone up 96%. Dividend per share has also gone up, and our stock price has gone up. So we want to be fully and firmly in control of the franchise value and hope that the market translates the franchise value to the stock price to the extent that the stock price also increases and people buy our shares. And this is a good outcome. It's a hat trick when you achieve those three things. And we feel that's where we are. Of course, there are challenges ahead with our markets, with global rates going up in the US and Europe. Yesterday, there was a big hit, our NSE. There are challenges of asset rotation. So stock prices may be challenged. But so long as the book value is going up and you can afford to keep a premium valuation, your stock price is higher than your book value, despite the market conditions. It came down, but so long as we can do that, we think we'll be doing the right thing for the business. Finally, is to put this all in summary. 2022 has been a standout year in terms of financial performance. There are challenges on deposits and loan-to-deposit ratio and fees and commissions, but generally everything else has been quite positive and pleasing. This forms the foundation for 2023. We actually think momentum on revenue will be sustained in Q1. And just some caution, because this is sentiment on forward-looking, and there are many reasons and disclaimers that if it doesn't happen, is forward-looking guidance. And still not very far out. And the reason is, in the environment we're in, who can tell you what will happen in November? So we have to think about this every quarter and kind of engage every quarter. So we think revenue momentum is going to be sustained. Efficiency ratios are going to continue. Upside, that upside is there. Pressure on quality, however, we think will stay well below industry average of 13. Way below. The keyword being way below. But pressure. So if you see 7.3 going to 7.5 and the industry is 14, hopefully we don't get lots of questions on why have you gone to 8. So we think that will be the case. Profitability momentum, we think that continues, and we have adequate capital to support growth. And then obviously that puts us in a very well defensive position if the economic environment worsens more than we think in 2023. So the headwinds are there. Rates going up to manage inflation will create more credit losses. Consumers may struggle to pay loans. This is real. We can touch it every day we do our purchase. And this means something to our P&L. Inflation might increase our cost a little bit. We have opportunities for risk-based pricing to make sure we can manage through that. And then there are other policy considerations. What's going to happen to the tax regime? We have a government that is pro-inclusive growth, which means needs more revenue. What does that mean for both personal as well as corporate tax? So these are things we have to reflect on as some headwinds in our financial outlooks. I do hope that gives you some information, and we'll engage more on the Q&A. Let me ask Yusuf to come and cover our forward-looking strategy. Thank you.
Thanks, Moses, for unpacking the numbers. I think we are bringing it to the end now in terms of just the presentations. Then we can be able to open it up to Q&A. I think just two slides that I'm going to cover. I think number one, you've seen the GTR strategy. We've unpacked that. And there's one thing that is very clear. The strategy is working. Now, when the strategy is working, you don't change the strategy. What you do is you increase the pace, you focus on the areas which you believe require more attention, and we only had one definition for the next horizon. And for us, that definition is outperformance. That's the next horizon for us. And how you define outperformance for us, in this market, we are looking at increasing our market share. We have quite a number of banks here. We know where we are from a perspective of market share. And so for us to outperform, it means increasing the portion of our market share relative to the industry. And so when you look at the next horizon for us, you're seeing it actually covers the three key areas of our businesses. So you have the first one there, which is having a modern day consumer financial services. And in there, we are talking about digitizing our retail, our retail segment. There's quite a number of areas where we see opportunities that will be able to take us to that outperformance that I've mentioned. We have three main areas in terms of, the affluent segment. We want to win in this area. We want to advance our relevance in the core middle and make sure that we can be able now to penetrate the mass market and also the youth. We have the necessary investments that we've already done. So for us now is execution so that we can be able to pick our market share in those areas. When we look at business banking, we were not participating in a big way. In the last horizon, we've been able to gain significant market share. And so for us is to make sure that we can now invest in channels that can be able to profitably be able to service this segment. So that again becomes a major focus area when we unpack our strategy. And then the last pillar really is a leading corporate and investment bank with ecosystem enhancements. That to us, we have seen it's working. We've done significant investments for our CIB business, giving us transactional capabilities that is working. So we want to enhance and make sure that we push on the side of execution just on based on the investments that we've been able to do. And then for me, really what is relevant, and I know Chairman, you mentioned this, is ecosystem. It's how do you bank the entire value chain, be it on the side of suppliers, be it on the side of distributors, and through the investment that we've been able to make, the partnerships that we are doing with different fintechs, we should be able to bank this entire ecosystem. So you have a corporate business that we are using our business banking, sector to be able to bank their suppliers, the corporate suppliers, and then of course to also bank the distributors. And to bring all of it together is then to be able to bank the retail, which is their workforce as part of our retail, segment. Chairman mentioned the three enablers. I won't dive into so much detail of this one, which spoke about having a digitally powered business. There are quite a number of investments we are doing there. We are looking at cloud-based technologies. We are looking at open API gateway that can be able to enable the partnerships that I've mentioned. And then now we are stretching it with machine learning and artificial intelligence to just make sure that all the investments we are doing, the target market we are getting, is all of that informed with the data that we have. We mentioned that having a trusted brand that is delivering on sustainable future. And we want to move from brand awareness. You saw our score, 28% jumping to 92%. Now we want to bring it to relevance, having customers who will be able to say, we consider you and we want to get our banking services with yourselves. And then really lastly here is a home of talent. I cannot overemphasize, it's our workforce that is able to deliver on this strategy and to make sure that the issue of diversity is really core, to make sure that, even from a perspective of sustainability, we are able to address that challenge. So, ladies and gentlemen, let's pause here. I know we've been speaking for quite some time. The presentation starting with the chairman, myself, and then Moses. We would want to pause here and then invite Charles to take us through the next phase of this presentation. Thank you so much.
Thank you very much, Yusuf. Thank you, Moses. And thank you, Chair. I'm just going to ask if we can find help in putting up 2 seats here on the stage. Okay, Moses, yeah, I'll invite you back on stage. To all our customers and stakeholders who've been following us on social media, on our social media platforms, on LinkedIn, YouTube, Facebook, we thank you so much for your interest in our business, and we hope that this has been an engaging session and for you. We will indeed endeavor to come back to you and answer some of the comments that you've left us, as well as some of the questions. But from us here, we just want to wish you a good afternoon, good rest of the morning and a good afternoon into the day. We'll be left with the rest of us here in the room, and we will take questions in the following format. We want to just allow the members of the media a first chance to ask questions that they may have of the presentations that we've gone through this morning. Post that, we'll take just a quick break. We've been seated for a long time, and then we can have a detailed session with with the analyst community. So I think in keeping with the usual format, just raise up your hand, let us know who you are, where do you work, direct your question to either of the gentlemen on stage, and we will endeavor to respond to your question to the best of our capability. Do we have microphones going around? Okay.